let's talk to an economist now. He's the chief economist at the Bureau for Economic Research, Hugo Pienaar. Hugo, nobody expected this hike. What was the Bureau's expectation?
Good afternoon. Very much in line with the consensus expectation, both from economists but also the financial markets. We expected a 25 basis point increase. So certainly this is more than both ourselves and the general expectation was.
What were the main contributing factors that was mentioned?
So, I think first of all, the Reserve Bank's inflation, the revision to the Reserve Bank's inflation expectation stands out. So they now expect headline inflation, so in other words, the broadest measure of inflation, to average 6.6% this year. So that's a dramatic upward revision from what they thought back in January. And it's also notably higher, again, than what the general consensus at this stage is. So that's first of all, they're a lot more concerned about inflation. They increased their food price outlook. That was not surprising because food prices have been surprising on the upside in recent months, but they went a bit further than just on the food price side. They're also concerned about our external financing environment. So what does that mean? They talk about our current account deficit. In other words, broadly, the difference between what we receive in export revenue and what we pay for our imports. And the Reserve Bank now expects that gap to be larger than what they thought before. So it means we require more external capital to fund that. And that plays into a view that the rand could remain under some pressure in the foreseeable future, which again poses a risk to inflation. So I think that's probably the two main factors that drove the Reserve Bank to this decision.
The Secretary also said that globally core inflation remains high. We did a story earlier this week saying that, for example, Ghana's inflation is at over 50%. So in February, you were increased to about 7%. What are we expecting now, just a bit in shorter term, of March inflation and also for the next few months? Is it going upwards? Are we seeing any respite?
So we think it's going to be quite sticky around that 7% mark for the next 2 months or so at least. We've already spoken about food prices, so those are likely to remain at elevated levels. We're going to get some relief on the food price side, though. Fuel prices in April, with the diesel price in particular set to decrease by around 60 to 70 cents per liter. So that's in April. So that will provide some relief to the April inflation number. But broadly speaking, sticky at high levels, overall inflation the next several months. But then from the second half of this year, so let's say from June, July onwards, we do expect inflation to moderate quite notably. And this is as the high base from the second half of last year starts to help us. So because we increased at a fast rate second half of last year, it's now in practical terms quite difficult to increase at another fast pace from that higher level. So those we talk about technical base effects, that should start to help us in the second half of this year.
Hugo, we as consumers, we're already in a tight position. We are not driving these hikes. Please put it into context. What other external factors are there that are driving these hikes?
So, we've already spoken about food. Of course, fuel or petrol was a big contributor. It's less of a contributor now, but certainly last year with the war in Ukraine, that really drove up the international oil price. So that was an important driver. And then, of course, the currency. The rand has weakened significantly since the January MPC meeting, and that risks further pushing up inflation. So it's broadly speaking, the external factors would be the currency. Well, the currency is, of course, a local factor, but it's driven by external factors, food prices, and then fuel costs.
If we look at historic data, the prime lending rate was at 9.75 in January 2020, before the COVID-19 pandemic. During 2020 and 2021, rates were kept low to give consumers a break, as well as to stimulate the economy. Do you think that was successful, given where we are now at 11.25%?
Yes, I think the context was, of course, very different. In 2020, with the economy crashing and with inflation low, because as the economy crashed, so did the oil price. So there was very little inflationary pressures in 2020, and at the same time, the economy was under significant strain. So then we cut interest rates significantly, and I think that did shield the economy. Consumers in particular, also business, from the lockdown. Of course, it couldn't fully compensate for the sort of once in 100-year shock, but it did alleviate some of the pressure. Now, then we moved to the end of 2021, early 2022. Now, inflationary pressures are building up quite significantly as economies across the world are opening up. Demand internationally recovers more faster than supply, so you have these bottlenecks emerging, and that results in a quicker return of inflation, and in some cases back to 40-year highs in some of our trading partners. So now central banks are on the back foot. They need to respond, and they responded quite aggressively. So it's just, two different worlds we're facing back in 2020 relative to where we are now.
Hugo, Dan also has a question.
Hugo, it's Dan Moyane here. The outlook, the domestic outlook currently remains very uncertain and volatile, as the Reserve Bank governor just told us. But when it comes to electricity costs, I mean, NERSA approved an 18% increase to Eskom, and that's going to be kicking in from next month. What's the likely impact of that on inflation outlook, and what should we brace ourselves for as consumers on the back of this 50 basis point increase in the repo rate today?
Yeah, so I think in general, most analysts already built in, a large increase on electricity tariffs, going back 6 months ago. So in the end, the 18% was probably a bit more than generally expected. Now, in of itself, 18% is of course above inflation, above general inflation. So it is another factor that adds to overall price pressures. But again, because that was sort of expected already in many people's numbers, that is not the main reason for the upward revision to, for example, the Reserve Bank's forecast. As we've already mentioned, it's sort of other factors. In terms of the impact of the 50 basis points, look, I think things now start to accumulate. Melissa's already made the point that we've now seen cumulatively lots of interest rate increases, and you've made the point already, people that have a mortgage bond or vehicle repayments, if you look over the last 18 months, those have now gone up significantly. So in a nutshell, it simply means that the money that's left at the end of the month for discretionary spending, especially in your lower to middle income consumers, I mean, that is now being squeezed, and it simply means that consumers are likely to have to cut back on, if they keep their house, they want to keep the vehicle, they probably have to cut back on some other expenditure.
Thank you. That was Hugo Pienaar, the Chief Economist at the Bureau for Economic Research.